Good afternoon. Welcome to the Everything Apartments podcast. I'm your host, Eric Christopher. I'm president of WSC Realty Advisors here in Long Beach, California, where I've been an apartment broker, owner, and property manager for the last 15 years. This podcast covers all aspects of multifamily investments, from buying and financing properties to day-to-day operations and management, and even into reinvestment strategies, which is where we'll be going today. We've got a great show with a great guest today, so let's get right into it. Over the last couple of years, I've been having increasing numbers of conversations with LA area owners about transitioning their investment out of state, meaning selling their properties here and doing a 1031 exchange into a different market and maybe even a different product type. Now, the catalyst for this increase in interest in out-of-state apartments or other products is now pretty visible. I feel it kind of started around the time Prop 10 got defeated in November 2018, and then right after our infamous state government simply pushed through AB 1482 to put rent control coverage in place statewide. And then we get into COVID last year, and we witnessed how the government's really just continued to victimize apartment owners with eviction moratoriums and draconian emergency orders around how we can collect rent, and if we ever will collect rent for that matter. And so this is, really simply has motivated more owners to consider a move that they may never have considered before. Historically, this kind of transition would be into a net leased investment. Okay, so you get tired of owning your apartments, you want to take a more hands-off retirement, but save your taxation status and save your income. That would be coming to you maybe through a Burger King building where the restaurant operator is on a long-term lease and the owner of the property really has zero management responsibility. And when it's put together right, they really are beautiful investments. I've got a client that bought a few of those a couple of years back, and he literally has never visited the property. He gets a wire transfer into his bank, and that's really the extent of his real estate management. So they can be a good solution. But the increase that I'm talking about has been for more people buying apartments or other products that maybe are a little more hands-on out of state. For example, in markets I've been studying like Phoenix, Tucson, Reno, over half of their apartment sales are going to California buyers. So that shows you what's happening right this very minute. So in keeping with that discussion, let's get into a product type you've all definitely heard of, but may not have considered for yourself, and that's self-storage facilities. And as I mentioned, we have a great guest to join us today. Christian Sonne is the executive vice president and national practice co-leader for the valuation and advisory self-storage practice. His team of 20 people does appraisals on some 500 facilities per year. He's spent over 20 years analyzing this product all over the country. And in 2012, he literally wrote the book on the topic with Self-Storage Economics and Appraisal. I think anybody in investment real estate would enjoy this read, as I did. Christian's also formed and successfully managed a self-storage investment fund surpassing $100 million across 31 self-storage facilities. So if there's anybody in the world, or certainly this country, that knows more about self-storage than this guy, I think we'd be hard to find him. We get a special chance to talk to the best in the business today. Christian, welcome, and I'm really glad you could be with us today.
Well, thank you, EC. Appreciate that kind introduction, and mutual respect back at you. Great to be here. Thank you.
Excellent. Excellent. Just as a quick segue into the product type we're talking about, tell us real quick, how did you get started? Was there a day or a frame of time that you were a traditional appraiser before, presumably doing residential or commercial properties, and at some point in time, you obviously transition into self-storage? Was there something that happened to you or something you saw that kind of motivated you to do that?
Yeah, I was doing a portfolio as a MAI appraiser of self-storage facilities, and there was a limited amount of data. They had higher rates of return, higher cap rates, and I saw this great opportunity for this cash flow based business. It's a fee simple interest. They're contracts, not leases. There's no tenants. You have customers. You have no bailment clause. And if people don't pay the rent, you got to sell their stuff.
Like we've all seen on those TV shows, right?
Yeah, right. Exactly. And so you have very low collection losses, and there's virtually, limited capital expenditures. I mean, you think about it, if once a customer leaves a unit, you open up the door, sweep it out, you're good to go. You don't have a lot of, you don't have leasing expenses or commissions. So it's very cash flow oriented business with higher returns, lower loan losses. And it's a very fragmented industry. Only about 30% of the sector is institutionally owned, where most core sectors in CRE, you would flip that 70%. So there's a lot of aggregation consolidation going on, which means opportunities to be able to build up funds. And that's exactly what's happening. It's self-storage in the last 25 years has outperformed all commercial real estate asset classes of core. Ones that would compete with storage are things like data centers, cell towers, very small sectors.
Mm-hmm.
So self-storage during the pandemic did extremely well. Self-storage has been recession resistant and apparently pandemic resistant. I just was looking at the returns year to date on the publicly traded companies are up 17% year to date compared to about half that for the Dow Jones Industrial Average.
Wow,
So,
that's really saying
yeah.
something, because we've seen the uptrend in the Dow and the S&P, and if you're besting that, that's really saying something.
Yeah, a lot of confidence in the sector, lots going on in storage, declining cap rates, higher values, and a lot of new investors, including giants like Blackstone, entered in a $1 billion transaction at the end of 2020.
So that's a great segue into the next question, and that is, most of the folks that will listen to this podcast and the folks that I've dealt with for the last 15 years are, or let's say they're in a frame of investment window between $3 and $10 million.
Mm-hmm.
And when you say something like Blackstone to me or to them, they're going to say, well, that I would never be able to compete in that playing field. Tell me about the distribution of deals out there, whether it be California or across the country. Is there a playing field for people to buy $3 to $10 million assets in this product type?
Yeah, absolutely. Because it's a fragmented industry, most of the transactions in self-storage are under $3 million. And I think it's something like 70% of the transactions are under 5, because there's a lot of smaller mom and pop owned facilities. We're talking about facilities under 50,000 square feet, maybe in the more class C type genre. And those are some of the assets I like the most, because they're good for either self-management. You can also, they're very accessible in terms of investment, with very good rates and terms in terms of financing. So that's the largest area of the market. So we do have this institutional segment that we all get excited about, and the Blackstones and the REITs and everybody else. But there's still a lot of mom and pop self-storage out there that is provides a slightly higher cap rate, and there's some as small as I've had some as small as 10,000 square feet in beautiful downtown Truth or Consequences, New Mexico.
Right. Population 585, right? And now
Yeah,
we'll get to that in the
that.
question. We'll get to that side of it in a minute, because with any kind of investment real estate, it's all about access to tenants and how easy it is to keep those units full, no matter what the product type is. But I'm jumping ahead here. So I'm just framing it up from, okay, so we have plenty of $3 to $10 million product available. So let's say I'm going to sell my 8-unit or 10-unit apartment building here in Long Beach. And let's say I own it for cash and I can get $2 million for it. So when I open my mind up to self-storage, I say, okay, you're going to tell me about the financing in a minute. Let's touch on cap rate. If I was to find a $5 million facility here in Southern California, what would my cap rate be vis-a-vis if I went to, say, Phoenix or even further out into more remote locations? Give me a little cap rate scale on that.
To give you an idea, over the last 10 years, the spread between a typical apartment cap rate and self-storage has averaged about 44 basis points, right? So
to the upside, I'm guessing.
I'm sorry?
To the upside, I'm guessing.
Yeah, self-storage cap rates are higher.
Okay, so let's just say you're 0.5% higher on cap rate, just for discussion purposes. Does that sound about right?
Yeah. Mm-hmm.
Okay. So 44 basis. I'm just taking it to 50 basis points for the ease of discussion here. So, okay, cool.
Yep.
Now, does that apply? Does that same spread apply here, there, and everywhere, or does it get wilder in different? I'm just trying to get a feel for uh, what my difference would be if let's say if I went to Tucson and bought an apartment building versus a self storage, or truth or consequence, which I'm guessing is even more rural or outskirts of somewhere than even Tucson is.
Yeah, so you kind of start to see, think of it like class segments. Remember that one of the unique aspects of self-storage is that the trade areas are very well defined. It's very hard to induce demand. So you can look at your supply and demand aspects in a very small trade area, typically about a 3-mile ring. So really it goes by class A, B, or C, even regardless of location. There still are some class A facilities in, say, a secondary market like Tucson. But in general, you're right, EC, the more, down the flow, the higher rate of return. So the smaller facilities in, semi-rural New Mexico are going to get a much higher cap rate. They're going to start in the 6.5s maybe. So it really depends on what the cash flow characteristics are like of that specific facility, wherever it's located. But the higher returns are always in those smaller secondary, tertiary markets. Those are some of my favorites because they have some of the best return opportunities, the best value add opportunities through management upside.
Yeah, and we'll get to that too. So I'm just kind of going with this little quasi model. I'm selling my building. I've been educated by you. I've followed the market, the self-storage market for a long enough period where I say to myself, you know what? I'm going to buy a self-storage facility with my 1031 exchange. So in thinking through this, let me ask you this, in going back to like the Southern California versus other market, what kind of vacancy factor? Because apartment owners usually here in Long Beach, LA, Orange County are underwriting their deals at 3%, and they may not even make it to that. I've ran at about a 1% vacancy rate for the last 5 years. And then you get into more external markets or further away markets. Obviously that's higher. Some of the stuff I looked at in Tucson and Albuquerque runs at a normal vacancy rate of between 5 and 8%.
Mm-hmm.
What do you normally see as the vacancy rate in some of these different storage facility markets?
Self-storage is definitely higher. An average length of stay is 12 to 15 months for a customer. So you have more churn, which is a good thing because it gives you the opportunity to raise rents. So really the large players REITs are in the 93, 94% physically occupied now. And if you think about it, a 12-month length of stay, that would be an 8% physical vacancy rate kind of ongoing, right?
Gotcha.
So you consider a little collection loss or concessions. You might give a month free to get new customers in. So 10% is very typical for self-storage. But we've seen it as low as 8 on a stabilized basis and as high as say 12, depending on the market characteristics.
Yeah, and I'm sure there's like a whole bunch of management component that has to do with some of that too in the more rural areas, right? I mean, the marketing and advertising. Okay, good. So we're higher than apartments, but obviously it's built into it's baked into the cake when we buy the facility. So now I'm in my exchange. I say, okay, I'm going to buy whatever. It could be Albuquerque, Phoenix. I know that I'm going to have a vacancy rate of 8 to 12%, at least starting out. What am I going to be faced with my debt options on that? Like what kind of LTV and what kind of rates, and just maybe just a little bit on the debt component?
Yeah, I mean, self-storage does not have the benefit of the public financing of Fannie and Freddie like apartments do. So it makes sense that cap rates for apartments are a little bit lower. However, it's widely, it used to be kind of considered a alternative investment class or, a specialty. Now it's sort of considered core plus or core. So really 20 years ago, Wall Street in the 90s started to throw them into CMBS pools, and then banks followed that became happy to finance. So now there's things like SBA options. A typical bank loan would be a 65, maybe 70% LTV, depending on, the other terms, you're going to get sub 4 financing, maybe a couple years IO on a 10-year deal, 25, 30-year amortization. And typically that's going to result in a cash on cash return to you pretty close to 5%.
Okay. So what I'm hearing, and those sound sort of linear to what we might like to have for apartments. We're seeing LTVs kind of cap out at about 65 at this point, but it's way more driven off the debt coverage ratio. At this point, we're seeing that drive the LTV differently than just the pure LTV. But it sounds like it's 65 to 70. That's pretty good leverage. And then the sub 4. Okay, so I guess my question that you just sort of piqued in my head was the compatibility with the SBA loan. Like if I'm gonna buy this thing, can I get I don't think I can get an SBA loan in the middle of a 1031 exchange. It's kind of a weird thing to think about. But if I had $5 million cash, or I had a block of cash that I wanted to buy this facility for, could I get an SBA loan on the whole thing? I guess I spent a lot of time trying to spit out that last part of the question, Chris.
I think I got
I
it
spent
right.
a lot of words to get out a simple question. Can I use it? Can I get an SBA loan on a storage facility?
Yeah, you can. And the very favorable terms, sometimes up to 90%, where a bank will do 50 and then the SBA 40. There's, especially for the smaller operators, and especially if you're going to, remember you're paying offsite management fees. If you want somebody to management for you, it's going to be 4 to 6% of your cash flow. Some folks say, well, I'm going to manage it myself. I'll take that 4 to 6% and operate it and be able to leverage. Then you can get the higher leveraged SBA financing.
It sounds like a winning equation for somebody that wanted to be an active self-manager, for sure. One thing I like, and I've talked to people about a few listings that I've just sort of shown people over the years in self-storage. I said, look, it's like an apartment building, but you don't have anybody living there. You don't have any plumbing. You don't have any turnovers. Like you said, even if the average duration of a tenant is only 18 months, or let's say 24 months in a longer run, you're saying, hey, you get in there with a broom, you sweep it out, and you put your sign out for rent. And I think a lot of apartment owners would get a kick out of that, because when you go into an apartment unit after somebody leaves, you never know what you're going to find, right?
Yeah. I mean, for sure, there are the occasional unusual stories of things found in storage lockers, but yeah, it's usually much easier to manage. There's a very strong social media platform, strong web page presence. There's aggregators, but all these things create presence online. About half your customers are now renting off their phones, which is kind of interesting, because you're even getting contactless rentals, where they just show up at the facility and you've left for them a lock and a bag and their contract paper that's been electronically signed. Don't even need to go into the office. Sometimes there's even kiosk management, a robot that on site that will manage the facility. That's very popular at smaller facilities.
Yeah, it sounds like that would be a business transaction that would be ripe for automation, right? Keypads,
Yes.
magnetic cards, just whatever. And that would give the apartment 1031 exchanger a way to get way outside of the management, be out of California, be out of apartments. And yeah, sure, you're going to maybe have a little bit of responsibility, or somebody that you have as third party would, but much less than maybe the traditional process, right?
Yeah, I think so. And also, yeah, there is third party management is also very popular for folks that don't want to run that day to day, and they do an excellent job. And they've got either some facilities with on-site or some facilities run by kiosk, but somebody that keeps an eye on it for you, that runs your social media, web page, your apps, so that you're able to get the traffic you need to make sure people come in the door. But there's still old-fashioned techniques that work in the small towns, like going to apartment buildings with flyers and telling the apartment manager, give you $20 for every tenant that comes, every customer that comes to my facility. Advertising in the local paper, real old school stuff, hitting the streets, kind of still works as well.
Sure.
In the smaller towns.
Yeah, it's interesting because as we got more and more tech savvy, it's kind of an overall statement. It's like we've got more and more tech savvy, and it's easy to forget that some of the old school stuff still works, right? Depending on your age range that you're communicating to, right? They're not on Instagram. They're still going to open the mail and see what flyers in it for sale on a listing or something. So it's interesting to keep those two things in balance. And on the management topic, because that's a big one, right? Because most of the people I work with, and I feel kind of myself this way, I love having my management portfolio clustered in Long Beach. I can get to buildings that I'm managing in plus or minus 15 minutes most of the time, which is a big plus. And over time, I've talked to for years owners that they really enjoy being close to their property. And who wouldn't, right? If you could be closer to your property, you would. But now we're talking about uh, a financial incentive or model that says, look, if you want to get the hell out of California, unless you move where you're investing in, you're going to be further away. So that's a trust fall for somebody that's never done this before in getting third party management. There's a lot of people that hate third party management. Obviously, there's a lot of lackluster owners that don't let the managers do their job. But that being said, the tendency is, wow, I don't want to buy anything in Arizona or, where I can't get to it in, let's say, an hour or two. Now, if you're going to go out of state, you're almost forced to trust a third party manager. And as I drill into that with storage, our normal street rate for apartment management is about 6%, let's say 5 to 6% on a normal building. What am I faced with self storage, given we've got a retail business, given we've got, let's say, maybe a few more financial transactions to do with running the business each month? Where does that stack up on your P&L each month?
Yeah, it's a 4 to 6% for your offsite management fee. And then you'd have a management fee also for if you have an on-site manager, payroll, if you will.
Mhm.
Um, a lot of the, but to your point about the out-of-state stuff, I mean, I have properties in 4 states. None of them are California. And yeah, it is at first challenging to get comfortable with this prospect of, having properties in New Mexico or near El Paso, kind of a long ways away. But I've had great experiences with third-party management companies that have worked in partnership with us that to be able to maximize our revenue and have done an excellent job for us. So I think that's and there's lots of folks to choose from, both national companies, regional, in terms of that. If you want to go that third-party option, third-party management.
Oh, good, because that was going to be kind of like the second part of the question is, are there national operations, or do you find a local management company almost in every market, which would kind of surprise me, that can handle the self storage product? And you kind of answered that, national versus local. I mean, what do you find works better? Is it better to have a local guy or gal, or do you find that the systems and the infrastructure of the national firm just kind of surpasses them?
Well, there's regional firms too that are awfully good. A person can compete with a national management firm. It is possible. There are smaller firms that own 8 or 10, and they're excellent managers. There's some that are here in Southern California that own some here in California and other areas. They have excellent platforms like web page, social media, because they pay attention to it. Because they maybe have some folks a little bit younger than me that work for them.
Sure, right, right.
But also they're also just, you made a point about old school. People still like to, you think of self-storage sometimes, you think of it's got barbed wire fencing and dogs running around as your security. And you think of the old couple in the office, the blue-haired lady and her husband, the smoker, and
Right, right.
and it's really changed now so that you've got, of course, cameras, security cameras, but also very well-trained sort of retail-oriented property managers that may live on site. Some actually wear a shirt, with a designated logo and things, and there's training for on-site managers.
Yeah.
And the software has gotten really good. There's 4 or 5 major providers of on-site management software that's excellent and can provide you with real-time 24/7 operational data, and also which helps you really keep track of your rates because of the ability in storage. you can raise rents at any time you like. So there's actually built-in algorithms to help you with pricing models. So, hey, somebody's been in 7 to 9 months. It's about time to raise rent 7 to 9%. And that, if you have a 40,000 square foot facility, about 410 customers, then you'll get a notice from your software that it's time to change rent this month on these 33 customers.
That seems like a big help, because it's, it's like this with apartment owners too. And you can get complacent. You're busy, you're doing whatever you're doing. There's a lot of things to think about. And sometimes raising rents, it literally gets into the back of your mind, and having a data resource that gives you, solid data on what the comps are. Hey, go do this. It's like, okay, versus now I got to think about what I'm going to do. So, I mean, and that's one of the beauties of technology. I switched my management portfolio, and actually in the process of doing it right now, over to one called Appfolio, which I'm sure would be similar in one that you use in the storage world, where all the back office transaction or conversation is all piped in through the platform. Let's say you have a leak in your bathroom, instead of calling me and me saying, okay, let me call somebody, and doing that whole loop of wasted time, they're going to key the thing in on the website. They're going to put a picture or a video of the issue that they have. They're going to choose 3 or 4 times of the day or the next few days that they'll be home. And then that work order goes straight to my technician's phone. I don't even have to hear about it. Obviously, I'll take a dashboard level look at it. Like, I'm not going to let a tenant say, oh yeah, put in a new kitchen for me, and it just happens without me knowing it. But I certainly don't have to be in the middle, or my staff have to be in the middle of every single little leaky faucet. And that's the beauty. And I'm sure you have the equivalence of that kind of platform with storage, correct?
Yeah. And it is also, as you mentioned, it's much more efficient, but for all people. Makes your customer, tenant happier, and makes your property owner happier, and makes the property manager be more efficient and happier. It's terrific.
Everybody's a winner with that. And so I'm excited to get there. So let me ask you this, because real estate buyers going out of product type, from apartments to self-storage, or any other product type for that matter, there's always a healthy level of skepticism. So what we've been talking about sounds really good, but think about, what are some of the challenges in self-storage that may not meet the eye for somebody coming in brand new, that, oh, wow, I didn't think about this. I mean, give me a couple of those, because I've got to believe there may be 1 or 2 that you go, oh yeah, watch out for X or Y. Any thoughts on that?
Yeah, that's a great question. I mean, it's easy to oversimplify self-storage, right? It's kind of somewhere between real estate and sort of operating a business, because you do have a lot of customer turnover. So it's sometimes people can oversimplify it. Fortunately, there are a lot of resources, from third-party managers to even courses, introductory courses on how to manage a small self-storage facility through associations and things like that. There's a lot of resources available, but it's a different model. Used to be people would say, oh, self-storage is a lot like apartments, and yeah, it kind of is. We get a lot of crossover investors into self-storage, but it's still not apartments, and it still is different. So I think people have to really do their due diligence up front without making assumptions about it. And things like this resource you're providing, hearing a little bit more about it, can go a long ways towards getting people kind of dialed into it.
Yeah, definitely. Very interesting. One little thought I had, just as we've been talking, I noticed some of the self-storage facilities I just sort of pass by driving around, they double up with offering truck rental, maybe have some retail. Does the office or store retail really ever add up to anything, or is that just kind of found money for products that you have? And then does the third party truck rental thing make sense, or is that just a can of worms that you don't need?
Yeah, I think most people believe that the third party truck rental, the administrative side of it, is really heavy and not as profitable. And similar with the selling of boxes and locks and other things, yeah, people offer it, but you're going to get 2%, 3% ancillary income off something like that.
Yeah.
Where a lot of ancillary income is derived from in storage now is in tenant insurance. So that a
Mm.
tenant can, even though you're not legally bound by bailment, you can offer insurance for the contents of their unit that they acquire through you. And you might make an extra $5 to $8 a month per unit by selling the tenant insurance. So a lot of folks have participation rates in the 50 to 70% rate. And if you think on a 10 by 10 in a secondary tertiary market, $100 a month, that's just a 5 to 8% increase that you're getting every month because of the tenant insurance.
Whatever you can do to increase that NOI, right?
Straight to the bottom line. And I'm talking about net after you've paid for the master insurer.
Okay. So there's a master policy, and you benefit each nominal tenant as they sign up, if they sign up.
Yep.
Very interesting. Very interesting. Wonder if you could do that with apartments with renters insurance. I don't see any difference, but that stuff's pretty cheap too. I tell everyone to get it, but nobody ever does,
Yeah. Well,
Good deal. So what else have you got? You got any closing thoughts? Because this stuff's really interesting, and I'll bet whoever listens to it's gonna peak up their ears, and because it's something that you're telling me 25 years, but it feels like, and maybe it's because I've known you, but it feels like it super got on the radar more recently than 25 years ago. And I'm not in the weeds with you, but I read Globe Street, and I kind of scan all the real estate journals as they come through. And it feels like the last 5 to 10 years, it's really got like on the radar and kind of in vogue. Is there any truth to that, or am I off base?
No, you're right on the money. You see, it's what happened is in the the GFC fallout, self-storage, of course, got hurt like everybody else, but it got a lot less hurt, than everybody else, and held up pretty well, and it recovered faster. Things returned to normal for storage very quickly after the GFC. So people noticed how well it performed during the big recession. And then we're having another surge now because, again, self-storage really performed well during the pandemic. So as a result, you're seeing more investment pile in. So after the GFC was a big surge, we're seeing another big surge now. And you also, in between there, you saw a construction cycle that was pretty heavy for about 3 years. It seemed like new construction of self-storage everywhere. And that's really slowed down, which is a good thing, keeps supply and demand metrics in balance. So I think it's increasingly becoming institutionalized and consolidated, but it's still only about 30% institutionally owned.
It sounds really intriguing. And from the simple idea that if you could take one thing out of the equation for a lot of apartment owners, it's really is dealing with the tenants after a while. And certainly you do have tenants here. There's always going to be some sort of friction between somebody handing you money for something you're doing for them or providing for them. There's no way around that. But the fact that they're not living there's something very refreshing around that. And the fact that there's not really any plumbing there, those two things get me interested right away. Right. So I would love to see myself at some point 1031 exchanging into a self-storage facility that has kiosk management that takes me approximately 4 hours a week of my own time. And I would call that a real estate Zen equation right there. So.
Yeah, I think that's right. That's a great summary of self-storage. I really like the smaller facilities in the smaller markets. They provide higher returns. There's the best opportunities there for value add. I think that under $3 million market is really where there's the greatest opportunities.
Well, I'm really glad to hear that, because my mind's going crazy. And I bet anybody listening to this that had an inkling around doing a 1031 exchange, especially out of state, this is a product type you really should do some research on. if you're thinking about apartments or you're thinking about a single tenant may be a little different because it's completely hands off. But this is one that Chris has just, kind of demonstrated that you can get into the smaller deal sizes where me personally, I kind of thought back in time a little ways that they were all going to be 15 and $20 million transactions. And it's very refreshing to hear that this could be a very viable 1031 exchange opportunity in the, 3, 5, $7 million range. And that's the most exciting part of, I think, of what I've heard you say today, Chris. So,
Excellent.
yeah, I think, unless you have any closing thoughts, I think we'll leave it there for today. Keep it relatively brief, but, man, I really appreciate you coming on. I learned something new from you each time I talk to you, whether it's for 10 minutes or something like this, where it's a little more focused. So I appreciate not only the education, but the time you're spending with us. And I hope the listener base also appreciates it.
Hey, great to be with you as always, Eric, and honored to be on. And yeah, always love talking shop with you, man.
Great. Thanks again. And I hope you enjoyed the podcast, everybody. We'll be back in a couple of weeks for another edition. And until then, invest wisely and have a great rest of your day.